Will Putin invade Ukraine? How will Biden respond? What does this mean for your investments? Hello, I'm David Wu. Welcome to the Money Game, where we make actionable predictions about the big stories shaping the world today. If you want to make some money, you're in the right place. If money is of no interest to you, the program is designed for anyone who just wants to learn about what makes our world tick. Before we get to the prediction this week, let's have a quick recap of the market last week. After a choppy roller coaster ride, both the stock market and the bond market ended more or less flat on the week. Looking more closely, many assets that had done well the previous week, like copper, did poorly, while assets that got clobbered, like Bitcoin, went up. Talk about lack of direction and conviction. Out of this chaos, we can still distill three themes. Theme number one, general risk appetite is down, but there are no signs of panic. What you see on this chart is my risk sentiment index. When the reading is above 50, the market is in the risk-seeking mode. When it's below 50, the market is in the risk reduction mode. Currently, it's at 35, below 50, but not close to panic capitulation levels. This reading is also consistent with the fact that speculators have been buying stocks on dips, taking advantage of the recent equity sell-off to build up long positions. Given speculators are usually the first to panic, the fact that they are buying just shows that nobody thinks that the sell-off is going to continue for much longer. Thing number two, the bond market thinks it's already pricing an aggressive hiking cycle by the Federal Reserve. As you can see on this chart, what the market has priced in for the pace of the Fed rate hikes is even faster than the Fed's own median projection. The market now places the so-called terminal Fed funds rate, the level the Fed's short-term policy rate will reach at the end of the Fed hiking cycle, at 2%. Thing number three, the best performing assets so far this year are those dominated by Russia. For example, Russia accounts for nearly 50% of the world's production of palladium, and palladium's up 25% year to date. Russia is the world's top exporter of oil, and oil is up 15%. Russia is the world's largest producer of nickel, and nickel price is up 8% on the year. Meanwhile, most of the worst performing currencies in the world year to date are those countries that either share a border with Russia or are within striking distance of Russia. We can summarize these three themes as follows. The stock market thinks stocks are cheap. The bond market thinks it is fully prepared for an aggressive Fed. The commodity and the currency markets think the odds of a Russian attack on Ukraine are rising. You may have no problem with any of these points of view. You might even agree with them. But let me tell you that there is a problem. That is, they can't all be right. In fact, I will demonstrate to you that only two at most of these three themes can be correct. A lot hinges on what Vladimir Putin decides to do about Ukraine. Indeed, what Putin does or does not do will have an outsized impact on the value of your investment portfolios over the next 4 weeks. Let me explain why. Let's assume for a moment that Russia will invade Ukraine over the next month. What would this mean for the global financial market and the global economy? Well, oil prices are very likely to spike further. This is because even though Russia is only the third largest oil producer in the world, it is tied with Saudi Arabia as the top oil exporter in the world. Russian oil export is so big that there is simply not enough spare capacity in the world to offset the loss of Russian supply should there be sanctions. Remember, even without Russia invading Ukraine, the oil price increase over the last 12 months is already the biggest we've seen in 20 years. You can think of higher oil prices as a tax on the consumers. When the tax goes up, consumers suffer and the global economy suffers, and recession looms. On this chart, we see that oil price spikes of a similar magnitude to what we've seen over the past year have been responsible for 3 out of the last 4 US recessions. So at what point does higher oil price become a serious problem? One way to answer this question is by looking at the correlation between oil price and the Dow Jones Transport Index. The transport index is made of airlines, rail services, trucking companies, so on and so forth. The chart here shows that until recently, both the Dow Transport and oil price were rising in tandem. This was because the recovery in demand for transport services from the pandemic drove up the demand for oil and thus oil price. But you can see that over the past month, the Dow Transport Index and oil prices have been moving in opposite directions, with oil prices going up and Dow Transport going down. The implication here is that one, rising oil price has nothing to do with the demand for transport services, and two, rising oil price due to the risk of Russia invading Ukraine has become a real drag for the transport industry. If Russia were to invade Ukraine, it is easy to see oil price hitting $100 a barrel or even higher. This would be, of course, a major blow to the global recovery. To the extent that this will likely shorten the Fed interest rate hiking cycle, it would validate the current consensus in the bond market that it's priced in enough Fed hikes. However, to the extent that $100 oil increases recession risk, it would negate the current consensus in the stock market that stocks are a buy. As I said, only 2 of the 3 current market themes can be correct. What happens if Russia does not invade Ukraine? Well, first of all, oil price is likely to fall back. The oil futures curve that we see on this chart suggests we could be looking at a drop of somewhere between $5 to $10 per barrel, which represents the risk premium the oil market is currently attaching to the possibility of Russian invasion of Ukraine. Easing oil price and easing geopolitical risk will be, of course, supportive for global growth. Meanwhile, COVID appears to have peaked in the United States. Based on the experience of South Africa and the UK, we should expect the number of new cases to go down as quickly as they went up. This means life could go back to normal quickly. We could see a strong reacceleration of the US economy, especially in the service sector that accounts for 80% of GDP by already early spring. More and more medical experts are reinforcing my view that Omicron may bring about an end to the pandemic. If this turned out to be the case and that coronavirus becomes endemic, it would be very bullish for confidence, of course. Remember, Americans are sitting on a COVID windfall that's worth a whole year's income. Moreover, with job openings at an all-time high, they're enjoying an increase in job security that they have not known for at least 20 years. What I'm trying to tell you is that assuming Russia does not invade Ukraine, all the pieces are in place for 2022 to be a great year for the global economy and for the US in particular. And what does this mean for the Fed? For 2022, the rates market is already priced in 5 25 basis point hikes for the Fed funds rate, the Fed's short-term policy rate. This seems like a lot, but is it really though? It is well established that over the last 20 years that the direct impact of changes in short-term interest rates on the US economy has greatly diminished. The effectiveness of monetary policy increasingly depends on how it influences the so-called financial conditions. In other words, an increase in short-term interest rates will be effective only if it tightens financial conditions. For example, by raising mortgage rates, or corporate borrowing costs, or by driving up long-term discount rate for pricing assets with long-term cash flows like stocks, and by driving up the US dollar. The reality is that notwithstanding the many Fed hikes now priced into the bond market, financial conditions remain extremely easy, as you can see on this chart. The beast of inflation, however, that stands today at a 40-year high will not be tamed as long as financial conditions do not tighten more. If you've been following this blog for a while, you would know that I've been calling for higher real long-term interest rates that I view as a much better proxy for the Fed's monetary policy stance than short-term interest rates. They've gone up 50 basis points over the last month, but I think there's another 50 basis points to go for monetary policy stance to reach what I would consider to be a neutral level. So what if Russia decides not to attack Ukraine? In that scenario, US bond yields will head higher still, likely dragging stocks lower. In other words, if there's no war, the current consensus that both bonds and stocks are cheap will likely to be challenged. To summarize my scenario analysis, if Russia attacks Ukraine, it will be oil up, bonds up, and stocks down. If Russia does not attack Ukraine, it will be all down, oil, bonds, and stocks. The most important takeaway of this analysis is that stocks are vulnerable in either scenario. Scenario analysis can be a useful tool, but a seasoned investor knows it does not replace the need for making good predictions. So the million-dollar question is, will Putin attack Ukraine or not? I believe we must always be prepared to change our minds when the facts change. I will give you an update of my view based on the flood of new information about Ukraine crisis this past week. On Wednesday, the U.S. rejected Russia's demand to bar Ukraine from joining NATO. On Thursday, the Chinese foreign minister called on the American Secretary of State to respect Russian security concerns in Ukraine. Also on Thursday, the U.S. warned Russia that it will block the Nord Stream 2 pipeline if Moscow were to invade Ukraine. Finally, on Friday, an unnamed senior Ukrainian official told CNN that Biden's phone call with the Ukrainian President Zelensky did not go very well, as Biden informed Zelensky that the U.S. would not offer Ukraine significantly more military help. Out of all this incoming new information, what really caught my attention was the talk of Nord Stream 2. The U.S. State Department spokesperson was very specific about Nord Stream 2 this week. He said, let me quote, "If Russia invades Ukraine, one or the other Nord Stream 2 will not move forward. We will work with Germany to ensure it does not move forward." In the same week, the German foreign minister told the German parliament that the Western allies were working on a strong package of sanctions covering aspects including Nord Stream 2. Why is Nord Stream 2 suddenly taking on special importance in the midst of all this crisis? Is it possible it is slowly emerging as a potential solution to the crisis? We will find out soon enough. In fact, on February 7th, a week from now. On that day, Biden will be meeting the new German Chancellor Olaf Scholz to discuss the Ukraine crisis. My gut tells me that Scholz has a greater incentive than Biden to do a deal with Putin. Not only Russia is a major export market for Germany, most crucially, 50% of German gas supply comes from Russia. With European natural gas storage at a 10-year low and natural gas price near its all-time high, a war between Russia and Ukraine could spell disaster for Germany and its new government. Scholz is known for being pragmatic. I think he understands what is at stake for Germany. In general, the German attitude towards Russia is not as black and white as in many other countries. A recent Pew Research survey shows that Germans are distrustful of Putin, but they're less distrustful of him than the Americans and the British. Another recent poll shows that an overwhelming majority of Germans is in favor of Nord Stream 2. My guess is that for Scholz, giving Russia the green light on Nord Stream 2 would be a small price to pay if it gets Russia to stand down on Ukraine. I suspect this is what Scholz is going to talk over with Biden on February 7th. How would Biden take it? I think Biden will be actually thrilled. You might recall that last May, under pressure from Germany, Biden already waived sanctions on a company building the pipeline in a marked departure from U.S. policy under Trump. Scholz offering to deal with Putin directly will take pressure off Biden from having to act forcefully against Russia. What a relief. Biden will be able to explain to his domestic hawks that Ukraine is a European crisis and that it will be only right for the Americans to support whatever decision the European allies decide to take to resolve it. Biden's key focus at the moment is Iran. Last week we found out that the U.S. Deputy Special Envoy on Iran, the architect of U.S. sanctions on Iran, left the U.S. negotiation team after urging a tough stance on nuclear talks. Biden might think that a deal with Russia could help him seal a deal with Iran. And what about Putin? A deal on Nord Stream 2, a project that's 5 years in the making, will represent a strategic victory for Putin. Not only it will increase Europe's long-term dependence on Russian energy supply, but it will also weaken Ukraine by allowing Russian gas supply to bypass the pipeline in Ukraine. I think Putin would take such a deal. This is what I'm going to do with my investments. The market has gone a very long way to pricing a Russian invasion of Ukraine. However, I think the odds are actually growing that a deal to ease the tension could emerge before the ground freezes over in Ukraine. For this reason, I'm going to take profit on my ExxonMobil position on Monday morning. Likewise, I'm going to take profit on my short euro position against the US dollar. Both of these two positions have benefited hugely from increased Ukraine risk. I don't want to be too greedy and push my luck at this point. If we look at my honest board, my long Chinese bond position via CNYB and short US bond position via TBF are still doing well. These remain high conviction trades. Disney and CCL are under the water with the recent equity sell-off, but this makes me like them even more. I have a lot of room to add to my long CCL position. My long KWEB position is also under the water, but this just gives me more attractive entry levels for the remaining 90% of the position that I intend to build in this trade. As for my 60-40 mark portfolio, last week was another decent week. I'm now beating my benchmark by 82 basis points year to date. I want to remain neutral weighting next week because I believe until the Ukrainian crisis is resolved, the market is just going to be treading water at this point. On that note, talk to you next week.